The next important source of owner funds is retained earnings. We all know that generally company earns profit and that profit will be distributed to the shareholders as dividends. But a company generally will not distribute all the earnings as dividends to the shareholders. So, some of the profit percentage will be retained by the business itself for future purposes. So, that kind of retained profits are called as retained earnings. It is also known as self-financing or internal financing or plowing back of profits, and it is one of the important source of internal finance. The merits of this retained earnings are: it is one of the permanent source of funds. It does not involve any explicit cost in the form of interest, and the funds are generated internally, so there is a lot of operational freedom and flexibility, and it enhances the capacity of business, and also it may lead to increase in the market price of the shares. Whereas the limitations of these retained earnings are: excessive plowing back of profit may cause dissatisfaction among the shareholders, because every person who is investing in a company, they will invest in it for a reason that they will get some benefit out of it. So if some benefit is only given to them and many profit is retained as earning, then they will not be happy about it. And also it is an uncertain source of funds. Why? Because every time or every year the business will not have profit. Sometimes it may have and sometimes it may not have. So the business cannot fully trust that. And then the opportunity cost which is associated with this fund will not be recognized. This may lead to suboptimal use of funds, that is the fund cannot be used to the fullest extent. So that is called as opportunity. So that opportunity will not be had in full. So the next one is issue of shares. We all know what is meant by share. Share is the smallest unit in which the owner's capital of the company is divided. A share may also be defined as a unit of measure of a shareholder's interest in the company. The total capital of the company is divided into smaller units, that is called as share. So according to the Companies Act, a public company can issue two types of shares. One is equity shares and the other one is preference shares. So now let us see what is equity shares. Equity shares is a common security which is issued under the permanent owner's fund capital. Equity shares are the most important source of raising long-term capital. So what are the types of equity share capital we have? So they are called as the equity shareholders, are called as the owners of the company. Equity shares are categorized into two different categories. First one, equity shares with equal rights, equity shares with differential rights as to dividend. So let us see what are the merits and demerits of this equity shares. Equity shareholders will not get a fixed dividend, but they are paid on the basis of earnings of the company. So what are the merits of these equity shares? The first merit is, that is first advantage is, it is suitable for the investor who is willing to assume higher risk. Risk jastiya irukum. Then payment of dividend to the equity shareholders, it is not compulsory, so it is not burden to the company. Then equity capital serves as a permanent capital, so when required they can use it. Then equity capital provide credit worthiness to the company, and then funds can be raised through equity issue without creating any change in the assets. And finally, democratic control over management of the company is assured. Why? Because equity shareholders are given the voting rights to select the directors of the company. Next, the limitations of equity shares. So there are major limitations while the funds are raised through the equity shares. However, investors wanted a steady income may not prefer this equity shares, because whenever the profit is there, that time only they will get the returns. The cost of equity shares is generally more, and issue of additional equity shares will dilute the voting power. Say for example, when a company is given 100 shares and when they are going to raise another 50 shares, then the profit will be diluted, and more formalities and procedures are there in forming the equity capital. The next is preference share capital. What is meant by preference share capital? How can we differentiate equity and preference share capital? Preference shareholders enjoy a favorable position over the equity shareholders in two different ways. The first one is they will receive a fixed rate of dividend continuously even if there is profit or not. Okay, and the second one is they receive their capital after the claims of the company's creditors has been settled at the time of liquidation. Liquidation means when the company itself is liquidated. At the kalachitu, when they are dissolving the company, once the creditors settled off, then the first right will be for the preference shareholders, that the company has to give money back to the preference shareholders. After that only, if there is something left over, they can give to equity shareholders. This is what the favorability which they enjoy over the equity shareholders. What are the merits of this preference shareholder? The first merit is they get a steady income in form of rate of return. Then second one is preference shares are useful for the investors who want fixed rate of return when comparative to the equity shareholders. Then it does not affect the control of equity shareholders because preference shareholders do not have any voting rights. And then payment of fixed rate of dividend to preference shareholders enable a company to declare higher rate of dividend for equity shareholders, because every time preference shareholders will get the same rate of interest in case of profit is high or profit is less. Then preference shareholders have a preferential right of repayment during the liquidation of the company. Liquidate பண்ணும்போது first right will be given to this preference shareholders, and preference capital does not create any charge against the asset of the company. They cannot claim any asset of the company, whereas equity shareholders can claim the asset of the company. So what are the limitations of the preference shareholders? Preference shares are not suitable for the investors who are willing to take risk. And then preference capital dilute the claims of the equity shareholders. Equity shareholders ku kadikka vendiyada dilute pannidum. And rate of dividend for preference shareholders is generally high than when compared to the equity holders. As the dividend on these shares to be paid, only the company earn profits. There is no assured return for the investors. Here also, when there is profit only, this dividend will be paid. So there is no assurance for the investors. The dividend which is paid is not deductible from the profit as expenses in the balance sheet. They cannot show it as an expenses. Thus, there will be no tax savings for the dividend which is paid to the preference shareholders. So these are the difference between equity and preference shares. This tabulation will give you a very clear picture of the difference between the equity shareholders and the preference shareholders.